Gold's over 10% off of its highs, silver over 15% off of its highs, and many gold miners have already corrected 20%. 6 days ago on a live stream, we were calling the top of the gold market, looking for this correction, and it's here now. Is it time to buy the dip? Let's dive into it. First, let me speak to those that are long-term gold investors, because obviously we're playing a game here of market timing and trying to sequence when are the asymmetric moments in gold. First of all, I remain quite decisively bullish gold. And those of you that simply want to hold gold over the long term, there's no reason why gold next year isn't going to see 5,000 plus on the upside. I want to highlight the fact that we specifically are always just seeking when are the asymmetric moments in gold and silver. When is it that you pile in and leverage a move versus staying positioned, whether hedged or underweight, and just and playing that game. Now, we were very specific up along the top just 5-6 days ago that the market was simply not asymmetric and that there was lots of room for gold to go through one of these mean reverting corrections. So now it's here. So let's quickly observe a couple of things. First of all, when I'm looking at this chart, I want you all to observe that even though we've gone through this violent correction, we are still actually at a higher price than where we were trading even a month ago. So this that has to be put into the frame that we still are actually at elevated levels. What is everyone's observing is that we had a ridiculous surge higher, and now that we're coming off of that ridiculous surge higher, we're now seeing a deep reversion that is making everyone uncomfortable. This was overdue. The way I look at the markets is that the markets are like lungs. When they advance, it's like inhaling, and then when they correct, it's like exhaling. And believing that somehow a market should only ever inhale and never exhale is a very foolish position. The reality is that this is the way the markets work. So what we were saying up at the market top is that while there was momentum and the bulls were completely in control, there was zero asymmetry. So we're now flipped. We're now in a situation where gold has no longer got bull momentum, but it now has asymmetry. So how do we frame this? How do we put this into context? Well, look, we've now reverted on gold back to a 50% retracement and trading now back to its 50-day moving average. This is a very logical place for there to be short-term support and even a bullish reaction. Now, if gold does what gold has done in the past and stays in a bullish frame, then what we may end up seeing here for the next few months is gold basically taking a break and consolidating. This, in my opinion, is the more optimistic scenario, because off of a move like this, gold will ultimately resolve itself with another bull advance in the new year, or maybe even in late December. The bigger question is, what is the risk here that this is going to be a little bit deeper, a little bit farther, wash out a little bit more? It's possible. We are now at a level where it's actually starting to become worth the risk of experimenting to find out where the moment is long. So up along the top, we were fully hedged up on gold. We locked in those gains through things like collars and other types of strategies to ensure that our profits were all locked in from that bull advance. Down along this level, we're starting to close those hedges to retake that long upside exposure. And that, I think, is a very tactical thing to do here at this level. The bigger question, is it the time to buy more? So one thing I want to stress is that as I'm buying this dip, I am going to actually have one foot out the exit door. I'm trying to discover when there is a reaction here, how the actual price action emerges and develops. If all we get is a very quick little bounce and the price action can't get any traction on the upside, the market would still become vulnerable, or gold would become vulnerable still for a deeper leg down. I'd have to reposition myself to be able to reduce that downside volatility impact on my portfolio. Overall, if I was to suggest that while prices are cheap here, the one thing I want to preface here is with longer term investors with a longer time horizon, that you may actually end up waiting even a month or more for this gold consolidation that's going to end up developing here for another major bull upside breakout. So you have to make sure here that if you're experimenting with with buying gold here, like I am, that you have the right time frame in mind. One way or another, we've gotten a correction. This is where the asymmetry is reset, and this is where traders should start paying attention. So let me go deeper into how I'm going to play this. Well, first of all, gold, when it was up along the highs, also we saw very high implied volatilities. We saw us get up into the 30 handle for implieds, which has made options very, very expensive in terms of putting them on. We've now reverted back down, and while we're not back in the teens, options are certainly getting cheaper. And this is where playing the gold trade, and particularly even silver, with a short-term hedge is still very interesting, because as far as I'm concerned, the volatility in gold and silver are here. As an example, we're at the exact same situation with silver. Here, if you come in here and buy this 50-day moving average and this 50% retracement, the one thing I'm interested in doing is hedging out short-term risk with a very short-term protective hedge on a silver position, and looking for a bounce that could easily on silver get to $48 to $50 on the upside. This is a very easy way and a very tactical level, because if the 50-day moving average doesn't hold, if we see the price action violating that level, that short-term protective put allows me to exit the trade and reevaluate what is actually the unfolding reality before us. So at this moment, the market is offering us a really interesting moment to take advantage of this, and I'm doing so with my members right now. The last thing I want to touch on here is the gold miners themselves. Now, we are below the 50-day moving average. We're already seeing that the gold miners have gone from peak to trough, a 20% correction, $17 on that GDX off of the highs. Now, we're also approaching this a very interesting level where we can experiment to see whether or not the gold miners are going to offer a short-term bounce. Overall, we finally got this reversion. There's a lot of amazing opportunities that are going to come from this reversion, because the bigger gold bull market isn't over. And so when you get these types of corrections, this is when you should be paying attention. If you want to follow along this analysis day by day, play by play, with the trades we're doing, the link is in the description below.